Hi, welcome back to another episode of Zeus TV. I'm Stephen Kaufman, and this is my co-host.
I'm Roger Salinas.
And we are live from the Zeus Mortgage World headquarters. Well, it's live to us. It won't be live when you're hearing it. But we want to do an episode today on what, Roger? What do you want to talk about?
Let's talk about how a hard money loan works.
Yeah, let's talk about it.
Okay.
Where do you
great.
want to start? Want to go through a scenario?
Perfect. Let's do that. A scenario.
Okay. So I'm a new investor, and I'm interested in getting a hard money loan. A hard money loan is a bridge loan or a temporary to permanent loan. It's a loan used to buy an ugly house that either won't qualify for traditional financing, you need to close fast, or some other examples. We have another episode that you can watch on more details about hard money. We're just going to talk about a hard money loan example.
Very good. Let's do it.
So I want to buy a $100,000 house.
100,000. I like those. 3-bedroom, 2-bath, 2-car garage.
Brick.
In a neighborhood.
Okay, good.
Very good. You get the idea. So 100,000. We're going to refer to 100,000 as the ARV. We use that term, of course, in the mortgage world. ARV means
after repaired value. It's just like the fair market value, except it's the value of the home after the repairs have been made. If you ever read an actual residential appraisal, it'll be called the after repaired value or the subject to value, meaning it's subject to repairs. So the ARV or the ARV is the value that the property has that I'm looking at, we're going to talk about. It's worth $100,000 after it's repaired.
So let's say the house is, it's a foreclosure. It needs repairs. Obviously, it's got boarded up windows and it's got a cracked foundation. And
high grass.
Very high grass.
Mail stacked up.
You've seen that house.
Yeah.
Very good.
Yeah.
So let's say that house is worth...
Wait, I live in that house.
Let's say it's worth $50,000. Okay, so the ARV is 100, you're buying it for 50, and the house needs 20,000 in repairs.
Okay.
20,000 to fix everything that we said was wrong with the property. So in that example, we would be
if you buy it for 50, it'll take 20 to make it worth 100.
Very good.
Okay.
I like that. So in that example, we would do a loan for how much, Stephen?
The typical loan to value or LTV on a hard money loan is going to be between 65 and 75%. So let's use the average of 70%. So we're going to loan up to 70% of the after repaired value, which we said earlier was 100,000. So the max we're going to lend on that deal, Roger, is going to be $70,000.
$70,000. And in closing cost on a $70,000 loan with our terms right now, you're probably going to be looking at about $5,000. So we'll do a loan.
That includes the title company fees, insurance for a year, and all the other stuff,
the
right?
appraisal and so on and so forth,
Okay.
including the origination.
Yep.
And all of that. So if that's the case, purchase price 50, 20,000 in repairs, you're out of pocket 5,000. For that example.
So because we're going to lend 70% of the 100,000, which is 70,000. It's going to cost you 50 to buy it, plus you're going to need potentially 20 repairs, which is also 70.
Yep.
But it's going to cost you $5,000 in closing cost and fees and prepaid items and of interest and everything else. So you're going to buy basically a $100,000 house, be able to fix it up, have $25,000 of equity, and you'll only be out of pocket 5% or $5,000. How much is that if you were doing that loan conventionally? What would that cost you out of pocket if you're buying a $100,000 house with a conventional loan?
Right. So if it was worth 100, you would need 20. Let's just say it's 25% down, so $25,000 out of pocket so far. Plus, remember, if the property needed any rehab, and almost always they need at least paint and carpet, right?
Yeah.
That's the common term for all investors. All it needs is a little touch-up paint and some carpet. So let's just say it's $5,000 in repairs plus carrying costs, and then another $5,000 or $10,000 or $5,000 in closing costs as an example. So in that $100,000 purchase price, you'd be $35,000 out.
So yeah, if you're buying the property, it was selling for 100, you'd have to put 25% down plus another $5,000 in cosmetic repairs, plus another $5,000 in closing costs. $35,000 compared to the $5,000 example we just had. There's no wonder a lot of investors are running to hard money. Those who know about it are running as quickly as possible. What about the repairs? That's the tricky part.
Yeah, well, the repairs, for instance, a lot of people come to me and they say, hey, all right, I'm ready to do the house now. Can I have my $20,000 check? So that's not exactly how a hard money loan would work. We won't give anyone any money to go out and do repairs, just give them a pat on the back and say, do good work for me, please. So what happens instead is the work gets done. They do the work.
Or they pay someone, or they do it themselves.
Yeah, of course. They'll do it themselves, which the program allows, or they'll get a contractor to do all of the work. Then they'll submit a request to us to get reimbursed for that money.
How long does the reimbursement process take?
couple days, 2 or 3 days too. They make a request today. Today's Monday. We send the inspector out on Tuesday. Inspector reports back to us saying, yes, the work was complete. It's done right. It looks nice. And they'll get a check the next day. On Wednesday, they'll get an electronic wire.
They'll get a wire or a check, I guess. We'll send it any way they'd like. And so it takes 3 days to get the money. They don't have to use the money if they don't want to. If they have credit cards or if they have cash sitting aside, they can use it. They don't have to use it. We still include it in the loan to value that the percentage we used earlier, the 70%. And they can do a draw for $1,000 or $20,000. They can do as frequent draws as they want. Every time they do request a draw, however, it's going to cost the inspector typically $100, somewhere around there, to go out to the property and make sure the property repairs have met code and that they're up to reasonable standards. And so, anything else you see about hard money in this example that we should share?
What if you were talking about they don't have to use the $20,000 if they don't want to? So what happens if they don't use it? Then what?
They don't pay for it. So it's like a credit card sitting aside only for rental properties or investment properties. It's just a credit card sitting there with a zero balance. You don't use it, you don't pay for it, so it's fantastic.
Awesome. So in that example, there will be a second loan that we'll want to do, which is the refinance, which we can talk about in our next episode. And the payoff in that example would only be $50,000.
Yeah,
right?
Exactly right.
Awesome.
So that's hard money. That's a hard money example. Tune into some of our other episodes on how to buy investment properties with no money down or understanding hard money, and it'll give you more insight on how to use this very valuable product. It's fantastic. Terms on a hard money loan range anywhere from, I think, 7.7 to, again, in the high teens. The fees range anywhere from 2 to 5%. And it's a fantastic tool. Again, you have to use the cost benefit to determine how long you should be in the property, what will it cost you compared to traditional financing, and what you'll have left over when it's all done. And most investors find that it's a really valuable tool. Anything you want to add?
That's it. I'm Roger.
I'm Stephen Kaufman. Thanks for tuning into another episode of Zeus TV. We'll see you next time.